Let's now look at illustration number 30. D Limited issues preference shares to G Limited for a consideration of 10 lakhs. The holder has an option to convert these preference shares to a fixed number of equity instruments of the issuer at any time for the next 3 years. The question is exactly the same as illustration 29 so far. If the option is not exercised by the holder, the preference shares are redeemed at the end of 3 years. The preference shares carry a coupon of RBI base rate plus 1% and is payable at the end of every year. Alright, the difference is in the previous question, it actually gave us a fixed coupon of 6%, whereas in this case, the question is saying that the interest is actually floating interest of RBI rate plus 1%. Alright, the preference shares have got a floating rate of RBI rate plus 1%. The prevailing market rate for similar preference shares without the conversion feature or the issuer's redemption option is the RBI base rate plus 4%. All right. Let us say if the same company, D Limited, would have actually issued shares in the market which did not have this conversion feature, then the interest rate would have been RBI plus 4%. All right. In the previous question, this was basically given as a fixed rate of 9% and the coupon was given as 6%. If you actually think of it, there was a gap of 3% over here as well. And over here in this question also, they've basically created a similar gap of 3%. All right. If let us say D Limited would have issued preference shares in the market without the conversion feature, the interest rate would have been RBI plus 4%. But because it is actually issuing with the conversion feature, G Limited, which is the holder, is foregoing a 3% interest rate, and the interest rate that G Limited is receiving is only RBI plus 1%. On the date of contract, RBI base rate is 9%. All right. So on the date of issuance of preference shares, RBI rate is 9%. The question is calculate the value of liability and that of equity. All right. It's actually the same as previous illustration. All you need to do is replace RBI with 9% because the RBI base rate today is 9%. You basically have to replace that RBI rate with 9%. All right. So ideally, the market rate of interest is basically 9 plus 4, which is 13%, and the coupon that D Limited is paying is 9 plus 1, which is equal to 10%. All right. So the market rate of interest, I'm just writing it down. Market rate of interest is basically RBI plus 4%, which is equal to 9% plus 4% because current rate of RBI base rate is 9%. So the market rate is 13% and coupon rate is RBI plus 4%, which is equal to RBI plus 1%, which is equal to 9% plus 1%, that is equal to 10 percentage. All right. The rest of the calculation is exactly the same. All right. How will we calculate the amount of liability? Liability will be the present value of the cash flows that entity may be obligated to pay, that we may be obligated to pay. All right. Therefore, we are going to calculate the amount of liability as now in this question as well. This has the characteristic of both liability and equity. Reason being, the entity is obligated to pay a coupon every year. All right. The question says the entity is actually obligated to make a coupon payment at the end of every year. So with respect to coupon, there is an obligation to pay cash. With respect to the principal amount, there may be an obligation to pay cash. All right. If the holder decides to convert it, there won't be an obligation. There will be an obligation to issue a fixed number of equity shares. That is the equity characteristic. If G Limited chooses to convert, then the D Limited has an obligation to issue a fixed number of equity shares, which is in the nature of equity. But if G Limited chooses to actually redeem the instrument, then D Limited will have an obligation to pay cash. And therefore, this is also a compound financial instrument. It has the characteristics of both liability and that of equity. So we will basically calculate the liability amount. We are going to calculate the liability amount as present value of the cash flows that an entity may be obligated to pay, that we may be actually obligated to pay. Remember, the stress is we may be obligated to pay. All right. For example, the rupees 10 lakhs amount of redemption, the entity is not always going to have to pay, but it may have to pay if G Limited chooses not to convert. If G Limited chooses not to convert it into equity shares, then D Limited may actually have an obligation to pay, and we are going to capture that in the liability value. So the liability will be calculated. We'll first have years. We'll plot the years as 1 to 3. The cash flow will be 10 lakhs multiplied by 10 percentage. All right. Remember, this time the coupon is actually equal to 10 percentage, and therefore this is going to be equal to 1 lakh rupees. Remember, although the coupon rate will actually keep fluctuating each year. All right, based on the RBI base rate, the coupon rate might actually change every year. If the RBI base rate is 9% today, it's not necessary that for the next 3 years RBI base rate will actually continue to remain 9%. All right, next year if the RBI base rate changes to 11, my coupon will then become 12. All right, my coupon will then become 12. But today, since the RBI base rate is 9%, I am actually going to do all the calculations based on the current RBI base rate. Yes, the RBI base rate may change in future, but I am actually going to assume that the RBI base rate stays the same every year. I'm going to assume that the coupon is actually 10% every year for the purpose of doing this split accounting where I have to bifurcate it into liability and equity. I am actually assuming that the RBI base rate remains constant. All right. For the purposes of actually doing the split accounting, the standard requires us to assume that the RBI base rate is actually constant. Yes, it can actually change in future when the cash flows are actually being paid out. All right. So we have cash flow of 1 lakh rupees, and at the end of third year, we may also be obligated to repay the principal amount of 10 lakhs. The discount rate is going to be equal to 13 percentage. The market rate of interest is 13 percentage. So the discount rate will actually be equal to 13 percentage. Let us quickly calculate the present value factors. All right, so the present value factor, annuity factor is 2.3594 for the first 3 years and 0.6931 for the third year. So the discounted cash flow is going to be equal to 2,35,940 for the first 3 years, and for the third year, it will be 6,93,100. All right, so the total discounted cash flow will be equal to 235,940 plus 693,100, which is going to be 9,29,040. All right, so the liability amount will be 9,29,040. I'm going to recognize the financial liability at 9,29,040, and equity will be recognized as a balancing figure. So it's going to be bank account debit of 10 lakhs to financial liability of 9,29,040 and to equity, which will be presented in the shareholders funds. It will be the difference of 10 lakhs minus 9,29,040, which is going to be 70,960. All right, so this is how we're going to split it in this case. All right, will the cash flow or the coupon rate in every year be equal to 1 lakh? The answer is no, but we are actually going to assume that it is going to be 1 lakh every year on day zero. On day zero, when I'm actually issuing the convertible preference shares, I'm going to assume that the coupon rate remains constant for the purpose of calculating the liability value. All right. Obviously, when we actually go out and pay the amount of cash, it need not always necessarily be equal to 1 lakh, because the RBI base rate could actually keep fluctuating. All right. So the coupon cash flow that I actually pay may change, but today we are actually assuming that the cash flow remains constant for the purpose of determining the financial liability value. All right. So the question also, the solution also has 9,29,165 and equity as 70,835. There's a bit of rounding that we actually have, probably because of different annuity factors that we may have taken. All right. So with that, we're done with illustration number 30.